Welcome to Founders Marketing Compass. Each episode, explore the challenges startup founders face in managing their marketing team. We cover everything from setting the right KPI to analyzing customer acquisition costs and aligning with long-term strategies. My name is Edgar Spivak. With my experience as a co-founder and as a marketer, I'm interviewing founders and investors to learn how they build healthy, lasting relationships between startup founders and their marketing teams. Before we dive into our questions, I would love to introduce Serhat Pala, the general partner at Cross Ocean Ventures. Serhat, thank you so much for taking the time being here.
Thank you, Edgar, for having me. I was looking forward to this.
I'm happy to learn a bit more about you, about your journey. I think it's super exciting. And when I heard it first, it was like, wow, you need to
Ah,
be on my podcast.
Thank you. That was some time ago, I guess, right? We met. Now, some say I'm in the dark side because I'm on the investor side of things. Even though I don't, see it that way. I'm a immigrant founder from Turkey to US almost 30 years ago. Came here for my graduate school to the US, and I found myself, even though I didn't intend to, I found myself, being a part of a startup right after my MBA, and loved the energy of the startup world so much that after a year, when that startup failed, I jumped in and, started my first company that, quickly failed, and then started another one. This time it took a little longer and more exciting. Eventually failed, but I think by the third time I got I got to a few more things that made that this time a successful exit. Long story short, between 1998 and 2020, I've started a few companies in the e-commerce SaaS space. And I like to believe that since I was a founder at heart first, that even though I'm on the investor side, I'm still a founder, at least by heart. And since 2020, I've been more on the investor side, investing as an angel investor, LP to some VCs that I also advised, but eventually, started a fund after I built a thesis around helping early stage, especially B2B SaaS companies that originate from Europe come and expand to the US and build their startups in US and ideally raise Series A in US. So that's what I've been focused on, and that's the very short version of my journey.
I think, with the journey of I fail, and then I succeed. Just need to be the highlight. And again, I think that every entrepreneur, need to listen to those. I think most of us fail most of the time, and we just need to succeed a bit and to make this success a big one.
I mean, I find myself nowadays when I speak to founders, speak a lot more times regarding my failures than my successes. If I was a exceptionally perfect founder that never succeeded, I don't know what I would be talking to the founders about, since they seem to get more value out of my failures. And eventually, like being a founder is about going fast, trying, pivoting, learning, failing. And if you do not fail, there's really no startup. As long as you can afford to make mistakes, and your successes end up bringing you more money than you lose with your failures, as a founder, you're good. That's all it takes.
I say we already have a great lesson in this podcast, even if we didn't even start at the questions. So as the focus of this podcast is to talk about this very complex relationships that founders, and I will say especially the one that are not coming from marketing, they're coming from the tech, from the product, they're coming from the business side of the venture that they're working in, and especially those seed to round A, they don't have a very dominant CMO, and they coming and they need to manage A marketing team, it can be 1, 2, 3, 4, 5, 10. They need to hire an agency. And one of the reasons that I started this podcast is that I have seen that there is a huge bridge between them, because they want their very nice go-to-market that they show to the investors, and now they need to translate it into KPI, into this is what you need to do tomorrow morning. And what I want to do in this podcast is to try to give those founders a set of tools that they will fail a bit less on this gap between them and their marketing team. Now, if I look on your opinion as an investor, what makes a startup's marketing team successful?
That is a very, very big question, very deep question, because people that have never had marketing as their primary function, I think what they fail to understand is marketing is not about just marketing. I think the terminology is probably not originally defined correctly, because when you talk about marketing, you're talking about the product, you're talking about the customer, you're talking about the logistics, the function, the before and after sale. You're talking about finances, you're talking about profitability. So marketing is the heart of the value that a company creates. Yes, marketing can be successful and startups might fail, but hardly ever you can talk about the successful company without a good marketing team. The number one mistake that I see in startups is to not understand what marketing is and fail to give marketing enough attention. And then that usually comes originally from startup founders that do not have marketing in their background, and they could be building products, or they can analyze problems and their own solutions, but when they do it without the lens of marketing and without looking at it holistically. So what makes a startup's marketing team successful is pretty simple. It's actually giving marketing its due, and it's understanding what truly marketing is and what type of role it is supposed to play in the life cycle of a startup.
Amazing. And I will go dive into the technical, because I know that a lot of founders, they love to hear the good inspirational words, but they want a set of tools. And on your perspective as an early stage investors, what are the marketing metrics that you look when you're assessing an investment?
Number one, and this is just not marketing, it's bigger than marketing, but one of my, I guess you can say, pet peeves, one of the most important telltales of a good founder to me is how much the founder knows about their numbers. And when you talk about a startup, you're in fact talking about originally the marketing numbers, because there's not many numbers at the beginning. When you're dealing with the company, you don't have high percentage of overhead and this and that. I mean, maybe some of the ways the funds are utilized to build a product that might make a difference. But at the core of any startup, you are talking about customer acquisition. So how well the founder knows their marketing numbers is the number one sign pay attention to in a company. How many months does it take for a startup to make their money back of their customer acquisition from a customer? What is the churn rate of their customers, and how does churn rates differ depending on the segment of customers? How does the marketing team and the founder determine the segments, and how they track the metrics between those segments are all great signs. Yes, there's a ton of marketing related metrics you could look into, but at the core of it, in my view, is how much the marketing metrics matter to the founder is the number one sign to me when I'm evaluating a startup.
I love it, and I will go even deeper with you, as we're in a world when if we talk about marketing, in the very wide aspect of this term, for many startup founders, and for many startups in general, it comes down to running ads on in Google, and Meta, and LinkedIn and Twitter and other. Now, when we see what happened within those ad platforms, and especially the direction that we're going 1 year, 2 years from now, when the ad platform coming and saying to those marketing team, "Hey, give me your budget. I will scramble everything. I will put it into my AI driven platform, and I will give you the best results." Now, one of the problem is that when you as that I faced, when you as a young startup, you not only want to have the lowest CAC, customer acquisition cost, because it must be on your brand and you don't aware to this. So it take many startup founders to a situation where they get in the CAC, which still is very, very good. But the reality is that that CAC comprises some from very new audiences, which is what they want, and I assume what you want. How much does it cost to me to bring a new customer that didn't know about you and turn into a paying customers? So they taking the trimming a lot of low-hanging fruit and they mixing it with some very new customer acquisition, and they give you a number which is really hard to understand.
Yeah.
Now, when those founders don't have the understanding of what's really going on, they coming to you and they telling you, Serhat, I know that you invested, and this is our goal meeting, and the customer acquisition cost, just for example, it's $300, and we have a lifetime value of $5, and everything is good. But the reality, if they will turn off all their campaign, they would still get some of their clients. So their real CAC can be 800, 1,000. Now, they're not lying because they're not aware of what they're saying. Now, I'm coming from the marketing, and I'm thrilled to know how does you as an investor go into those numbers in a situation that can be very uncomfortable, coming and saying to your founder that you invested in, hey man, maybe you need to check your numbers again. How does that look in your board meeting, in your relationships with your founders?
Really good question. And I have to say, as much as it makes uncomfortable discussions, it also makes very comfortable and very bonding conversations as well with the right founders. First of all, when we talk about any type of marketing metrics, and you're dealing with a founder and the founder team, it is quite straightforward, especially for investors that have operational experience, to understand how sophisticated that marketing team is in how they look at their numbers. Because you shared a great example of how a customer acquisition cost might look very reasonable, but when you take out the free, the referral, the repeat, and all that kind of stuff, you might be looking at a terrible customer acquisition cost under the surface. There are many different. A team might explain their metrics to you, and either when things start doesn't make sense to you as an investor because you know how those numbers come together, either they, as a marketing team, they don't see it, which makes them unsophisticated, which makes me worried as an investor, or they are using the numbers in a way to tell a story that might not be as truthful and honest as it could be. So, as an investor, I don't see my job as teaching, but it's more initially analyzing and then supporting. There's a difference between taking a role as an investor to teach the team so that they can be better. It's more about not teaching, but asking the questions that might lead them to look at things differently. I don't think my job as an investor is to help them analyze things the right way. They are supposed to get to that conclusion themselves. So that's the negative, the flip side. That's the negative side of things. But on the flip side of things, if you're an investor that understands marketing and understands the metrics and are caring enough and hardworking enough to go under the surface, multiple layers to understand what's going on beyond just the simple metrics that might be a part of your thesis or that might be part of your experience, then you could find a special bonding with the founder. And this is what I mean. For example, we had this amazing startup. It's a small B2B SaaS company from Latin America. And the general momentum of the company was great. They were growing, and they were, they seemed to have a product that had momentum. But they were having a really, really hard time raising funding because their churn rate was on the higher side, not double digit, but close to double digit. And they were being rejected by many B2B SaaS investors because many of those B2B SaaS investors have certain metrics that they want you to have before they can invest in you. So because we thought that there was momentum, we believed in the founder, and we believed that that this is a relatively a new type of value proposition, and they were coming from a geography that is not as matured when it comes to marketing and SaaS. We decided to drill deeper into these numbers to understand the churn and what makes the churn what it was. We quickly realized that it was the marketing team and the founders' drive to try as many different marketing methods as possible that have a bunch of different type of metrics, and their inclination to try a lot of different things made them go and get a bunch of different type of customers. And quickly they realized what stick, what didn't stick. But because they wanted to grow so fast and they were very resourceful in the way that they acquired these customers, they could afford to experiment a lot. They keep losing a larger portion of their customers as churn. But the truth of the matter is, they understood and then they let it go. They understood, they let it go, but they keep doing it over and over and over again. That contributed to their momentum and growth. But on the flip side, that meant a high churn. This story was very, very, very much under the surface. It was not very apparent. We had to spend a lot of time looking at their numbers and got the marketing metrics and did the analysis ourselves because we wanted to invest in this company, but we wanted to be careful. And once we were able to tell them and said, look, we believe your churn is bad, but we believe your churn is bad because of this reason, they, in fact, learned from that experience and they changed something, and it even impacted them to use the analysis that we did to go and raise more funding from others, because now as an investor we were able to solve that puzzle. The reason I told that story is because just like the metrics that might not be as transparent and straightforward, that could be on the negative side. You could have these type of stories where investors can bond with the founders because they show them that they have the sophistication and they have the understanding of marketing as not just as a tool, but overall story of a startup.
I think this is an incredible story, and I hope a lot of your colleagues will listen to and then will learn from you in being such a helpful investor.
We did, I don't know, like with that particular case, we did more than probably we were supposed to as an investor. But the reason that we did that was because the founder was great, the team was great, there was something there, and it was just that churn number that was a major
really
negative.
stopped you from signing this term sheet.
And everybody else. I remember having this conversation. They keep getting rejected from a bunch of really good B2B SaaS Bay Area investors. And we are thinking to ourselves, look, we must, those guys are smart. but let's not take it for granted. Let's go and see what it is. We would really like to understand it. It took a long time for us to figure that out. But once we figured it out, then it becomes such an easy investment decision because we said, okay, everything else was good. That's what they were missing. And I think we found it. We can go ahead with it. And it has been a great journey so far with that team. I'm, like one of the great portfolio companies.
I just love this story. And I'll go for the next question and try to understand from your perspective, not this amazing Latin company, but what's the biggest marketing mistakes that you see startups often do?
This is actually something that you and I talked about. And in fact, I think I learned that from you originally. And I did not think of it. So I'm going to turn back and respond to you with something that I learned from you. And that is about crossing the chasm. When marketing teams mistake momentum of early innovation or early innovators and that type of mindset in their customer as the mainstream and develop products for the early innovators as they grow that base, but then they get stuck in making
you make this lead and then you stop. And then you grow like this. So having this hockey stick, you grow. Everything looks amazing. And then it's my pleasure. It's my pleasure to give you a lesson.
Yeah, and I learned from you, and I actually shared this lesson with multiple founders in a very productive way. I think that that lesson that stuck with me, I also was able to share it with some others that benefit.
And if I look from the opposite side, if I talk about mistakes, what is like a type of approach, a marketing approach that you say, wow, I love this company. I might not be sure about this, but I think the way they execute their marketing strategy, and I love it. And I believe this will make me to put my money on this company because I love their marketing approach.
I see. That's a tougher question. I don't know if there's one thing, but some signs I can maybe talk about. Maybe that will trigger something else. But like the resourcefulness in marketing, and I'm not just talking about like the growth hacking. I'm talking about the resourcefulness, how they look at the problem from different angles and do not create solutions that are so straightforward. So that's one. Number two is how they tackle the product development process. I don't have I haven't yet actually came up with an answer with this. In fact, I talked about this with another product manager friend of mine the other day. We had the debate around this subject, which was, when is a good time for a startup to hire their product manager? Because most of the startups, even if the founder is not coming from a marketing background, oftentimes the first product manager of a company startup is the founder. And just like any product manager that have never been a product manager or that have never really had looked at product management and development as a profession, they break things, kind of like wing it for a while. But there is a place for a startup to decide on what is going to be my product development and product management expansion growth plan. So the way the founder looks at product development and product management, even if they might not have a marketing background, but just the way they look at that challenge, opportunity, how they prioritize it in the way they are looking at the future, how they dedicate their budget with their fundraising, specifically around product management and product development. I think those are all some great signs that makes me understand that this is a company that is is serious about solving the problem and understanding the customer and doing it in a tandem way rather than like use their funding or technology to make the solution happen.
I love it. And I will say, if I want to dive in, and let's go back to the problems, and I look from the one common mistakes that startup founders do when they managing their marketing teams, what will it be?
I think it's about acquisition over retention propensity. Because when you're early, when your numbers are small and growing, when profitability is not the name of the game for you, you have fundraising. It is, yes, you have to learn, you have to explore, you have to come up with different hypotheses. But if you have this very high propensity to favor acquisition and growth over retention and engagement, that's a bad sign. It's almost like a sign of an addict that, yes, they might be still drinking one glass of wine tonight and tomorrow night, but you can tell if that person has a higher propensity to be abusing the substance. You kind of have to look at it really carefully because it might not look so bad, but just even the way they are approaching their budgeting or their explanation or excusing some of the things that they do can give you signs about how their mind works.
I will say that I saw personally mainly around like 2021, so many startups, that like you said, I think I like this term that you said, became so addicted to customer acquisition costs without realizing, they spending $3,000 for a $500 client, and just go wild. And I definitely take you on that. And I'll go with our last three questions that I really hope will be more founder related. And I will ask, what is the common misconception about running a startup that you would like to debunk?
As an investor, I will go for with an investor related common conception that the founders do all the time. It's such a common misconception shared by founders that I would like to debunk that one if it's possible. And that is founders, when they try to raise funding, they go around and talk to a bunch of investors. And when they talk to a bunch of investors, they try to convince those investors how little there is risk, how true this proposition that they have, because they are such a great company solving such a big problem. I would recommend the founders not have the desire to talk about how small the risks are or how they don't exist, but rather what those risks are and what they could do about it and how real they are. Because the founders, I think, making this wrong assumption that investors are looking to invest their money with as little risk as possible. And they're coming from that angle. On the contrary, I mean, investors are not stupid. They know that if there is no risk, there is no reward. And larger the risk, there is larger the reward. They should understand the risk. Yes, that's an investor mistake. They sometimes take risks without understanding them or without quantifying them, both upside and the downside of it. So what I would like to debunk is founders, when they're talking to investors, please be as clear and open about the risks and what they mean. By doing it, not only you will get credibility, but then you will have a better chance of talking about the upside of the opportunity rather than how minimal the risks are.
Love it. And if you could give yourself, going back to 2000, you're starting to invest, you sold your first company, you're just starting to be an investor in the Silicon Valley. If you could give your younger Serhat one advice, what would it be?
From as an investor, not the founder.
Yes.
I think the first one is know what you don't know. be around people that have different perspective and expertise and experience, and learn from them first before making investment decisions. Because founders, especially the founders that have exits, they tend to find themselves successful. They feel like they know better, and they've seen things, and they have the inclination that they know better, and they, because they think they know better, they make bigger bets. I think my worst investments were the investments that I did the first 12 to 18 months, because I didn't know what I didn't know, and I didn't have the network to be able to go and listen to when I was looking at deals. Yes, of course, we have to, as investors, just like we have minds, we have hearts, and like we invest within the using both of them in a combination. But as if we surround ourselves with diverse group of other investors that we can talk and collaborate with, we'll have a better chance of success. So I would go and tell myself is 18 months, take notes. If you're going to write checks, write them, but don't give it to them. The founders, go, and then just like the first 12, 18 months, just learn and don't invest. Just listen.
If I would ask the same question as a founder, before you started your journey, like you finish your MBA, you're going, you build one company, you fail, you build second company, you fail, you build third company, you make a huge exit. So if I start this Serhat just graduating his MBA, what is the lesson you would give to yourself?
The lesson is there is a cost of being a good business, a growing business. If you are not a growing business, you can come to work on a Monday morning and you might not have any problems. Nobody might call you, complain to you. You have not enough employees that will come and ask for stuff, or angry customers or partners. So what I would tell myself is, if you want success, if you want to build a company, you better grow a thicker skin, patience, and the expectation that you're going to have to deal with a lot of things you do not want to deal with, because that is the only way a company can be successful. And then create that mindset that problems mean you are maybe becoming more successful. It's not like, like yes, there are things you can do to make your life easier, but there is this, I think, if you can develop that muscle in your mindset that says problem, that means that something is good.
Something happened.
Yeah.
And for the last question is, what is the question that I needed to ask you, but I didn't?
I would answer this probably more as a founder. The question that you should have asked me, I think, your personal life, finding your partner, your support system, and what it means, and how important it is for a successful founder. Because we are founders, that is a part of who we are, but who we are is a combination of what we do and how we live. And how we live and what we do really depends on the immediate support system we have that starts with our life partners. And the question you should have asked me was, what do most founders pay least attention to that they should pay most attention to? And that is knowing like how to find themselves a good life partner, and how to build a life and a communication system to be able to sustain that relationship.
How I'm sure that every founder and investor who will listen to this conversation will find it helpful. And just to say thank you so much.
Thank you very much for having me.